Hello, this is Tom Harden.
And Brandon Bischoff with Canterbury Investment Management.
Today's date is April the 25th, 2019. And today, Brandon and I are going to talk about the driver of the markets, which is supply and demand. Supply and demand is driven by investors and what investors believe and how emotionally they believe that their future predictions are going to be true. So as a result, we'll see a lot of different market environments over a period of time. Some that are very stable, others that are more volatile and bearish.
So today what we're going to do is we have studies that go back on the markets back to 1896. And so we're going to show you two very different time periods, but very similar market events and how those events transpired. One will be over the course of, say, the last 9 months from about June 2018 through April 2019, and the other event will take place in 1998. And we're going to compare and contrast those events.
You're looking at a chart of the Standard & Poor's 500 from April to October in 2018. And as Brandon says, we've done studies on the Dow going all the way back to 1896. So we have over 30,000 trading days of data. And what we'll find is there's a number of periods when investors' emotions and feelings were very similar, and that related to very similar chart patterns. And when we look back at the last year, we're really looking at a very unique period. And we found, I think it was 6 periods that were similar to this going back to 1896.
So I'll start by explaining this period here. So we can see that from April 2nd to October 3rd of 2018, which is a 6-month period, the market went up about 13.3%. Now that's a high percentage over a relatively short period of time. And you'll notice that the market did this on declining volatility, which is a bull market characteristic, but actually enters a period of extreme low volatility here at the end, which is below CVI 45. And what we find with extreme low volatility is it's kind of like the squeezing down of a spring. It becomes so low that eventually you might experience an outlier day beyond 1.5%. And so Tom's going to read an excerpt from our blog on October the 2nd, 2018, which is this day before the chart ends.
So the blog says the current environment is one that has higher than normal probability of 1 or 2 outlier days of 1.5% or more. The current market is also more likely than normal to experience a pullback that should remain within the parameters of the 8 to 12%. Again, 10% is a normal bull market correction. Our portfolio thermostat operating system had already adjusted in anticipation of this potential pullback and will continue to adjust as we move forward.
And so now we're going to look at a similar chart pattern in 1998.
Now, this is a chart going back to the beginning of 1998, and it's very similar. And first of all, there are no two markets that are exactly the same, but we can see investors' feelings were very similar. This one goes back 6 months, and you'll see an 18% gain in the market with virtually no corrections, which is very similar to what we just saw.
So yeah, as Tom was saying, this chart goes from here, 2/2/1998 to 7/17/1998, which is again a 6-month period of 18%. And the similar characteristic is this happened on declining volatility as well. And the last chart went into extreme low volatility here at the end, and this chart doesn't quite make that, but it does decline over a relatively short period of time. You can see that it was actually coming from really high volatility of about CVI 125.
Yeah, Brandon, I think it's also interesting to note if we go back to the left, both of these markets came out of a more volatile period. Where it had a meaningful correction, and actually the volatility over this 9-10 month period got as high as 124.
Yeah.
So that's a pretty significant decline in volatility.
And now we're going to move on and look at, what's the result? What happens after this high on each one of these charts?
Okay, so now we come back to 2018, and if you see the black circle, that is where the chart from 2 back ended. 10/3/18, and you can see the days that followed gave us our outliers. Now there are 2 huge outliers at that point, and that completely changes the market psychology and the environment from one that was very complacent to one now that is pretty much emotional. And we did a blog on October the 15th, and it said this: The pressure from the extreme low volatility has now officially been released. The sleepy market has been hit in the face with a cold glass of water. Right now, the market doesn't know where it is or where it's supposed to be.
And following these sharp declines like we see here on high volatility, you're going to be prone to kickback rallies. So that's what we see here. And then it starts to decline again to retest this low. And it actually breaks down through to here. But that's still within a normal 10% correction. And then from this point, it just sort of does a W formation where it's testing this resistance and testing this support. So now what we're going to do is we're going to move back to the 1998 chart.
Now we'll go back to 1998, and the scale of these charts are a little different. But what you'll see is we're going back again to that peak, similar to the last chart, and that's following a, was it 17%?
18% rise.
18% rise. So now we begin to see some sharp declines and a big outlier. And again, this goes back to about 10%. And we're saying that 10% from the peak is pretty much random. Now, again, it got there pretty quickly, just like the other one in the same manner. We get a kickback little rally here, and then we see a decline that comes back to that same level again, another rally, another decline, and then a little rally from here. So we have that same support and resistance that Brandon talked about, which shows where supply and demand shifted. At the bottom side is where demand begins to take over from supply, and it moves up. And then when you hit the top level, that's where supply begins to be stronger than the demand, and you go back and retest.
So then now let's take a look at the next two charts, which are going to show what happens after these endpoints. So this chart right here picks up back in 2018. And so if you remember 2 charts ago, we were sitting at this point here about 10% from this high back on October the 3rd of 2018. And what follows is sort of an unnormal market event. You see over the course of 7 days, the market falls an additional 10% and is now actually 20% down from peak value.
Yeah, so based on our study, there's been 27 periods where it would have stopped right where that red circle is, and basically either went sideways or up from there. And this would be the 6th event where it actually broke down and went into something more significant, where we're seeing a 20% correction.
And we're going to see a similarity in the 1998 event.
So now we go back to 1998, and we're seeing almost the not exactly, but very close. And then we have that 10% correction, and then it breaks to the downside. And in 3 days, you're seeing another 10% correction. That's a total 20% correction. Actually, that big of a decline has only happened one other time, and that's this time.
Yeah, that's the 2018 period.
Yeah, and in the blog it says current market behavior is extremely rare. There have only been 5 periods over the last 122 years, and now a 6th one. But this one, along with 1998, are the only 2 that corrected as far as 20%. Now, what we know from this is that we should get, or will get, a kickback rally that should recover at least 50% of that decline, and we'll see what happens.
Yeah, so the next chart's going to show both of these events side by side and their kickback rallies. So now we can see both charts side by side. So this here on the left is 1998, and on the right is 2018-2019. Very similar charts. You can see a 10% drop from peak portfolio value, and then you see a fluctuation kind of in a trading range on both charts. And then from these 2 points here, we can see a very fast drop of an additional 10%. So you're now down 20% from peak portfolio value on both charts. From that point, they each rallied over the course of exactly 17 days to gain back 50% of what they lost.
So that was a pretty emotional time, and when you're at this point down 20% coming out of a low volatile environment, that is not it's only happened 2 times before. We've had other cases where you've had a sharp decline, But what we can expect is what we would call a kickback rally. Here's a quote from January the 7th. Canterbury studies show that sharp declines are followed by sharp advances. And it's like kind of stretching a rubber band. That fast 10% stretches it, and then we go to 20%. In our studies, we have never gone from a low volatile environment straight to a bear market. It's a process. So we would expect this rebound coming back. And then as we look at this from a portfolio management perspective, we want to be sure that this last 10% here, the whatever exposure we had on that side, we want at least that much or more on the rally, knowing that that's going to occur. So the fatal flaw is that most people will lighten up, or some people even sold out here near the bottom. And if you don't catch this rally, I mean, that's 10% over a period of 2 or 3 weeks. That's going to be hard to get back. So the question now is, now that we've gotten this 50% back, we know that it probably will not go into a bear market based on history. What do you think is going to occur from here? What do you think is most likely to occur?
Yeah, the probabilities would be in favor that you're now approaching overhead resistance, so you actually might go down and retest this low. But we're going to take a look at each chart, starting with 1998, to see, what happens next. So here is that 1998 chart. So this one picks up where the last one left off, and you're right at that 50% retracement. And from this point here, you can actually see that over another short period of time, the market drops 10% to retest this old low here.
And that's very typical, that you'd retest a low. And again, that's 10% over about 7 or 8 days. So the question goes back to where we have this red circle. What should we be doing with the portfolio at that point? And what we're saying is it needs to be stable. We need to stabilize it. We're within that 10% range. We don't want the portfolio to have a decline of more than 8 to 10, 12% from the peak. This was kind of an anomaly, but we know at that point we have to stabilize it, and we do that by using some inverse securities to move the opposite direction of the market, and some alternative ETFs that are not directly connected to the stock market. So right here is where we were. This is really right up to date. And in this case, you did not see a retest of the old low. You had a V bottom, which is extremely rare. And you saw another 10 to 12% advance without any meaningful correction. That's 20%, really getting right back to where we started in really just a couple months. Now, again, our portfolio was stabilized at that point. That's 11 or 12% on the S&P, which again is not really very rational. You would expect it to have some backing and filling, and it's still made from this point. But from a portfolio management perspective, we don't want drawdowns. So we stabilized the portfolio where the big red circle is. And I think from that point, we got about 4%.
4 or 5%, yeah.
Of that advance, where the market is up 12%. But again, we're looking at a market that is highly emotional and stable, could really do pretty much anything at this point. And 3, 4, 5% over the last 3-4 months is pretty good. And the idea of catching the whole kickback rally, basically we've handled that as good as we could possibly expect. So what can we learn from these charts? Well, we know that markets go from very efficient, almost no outliers. Corrections are typically, 5% or so, to something that's looks almost to be irrational. But again, is followed along to be kind of the opposite of what people think. Markets are counterintuitive. So if we go back to 98, you can see that broke down, retested the low, 10%, which we definitely would not have wanted to experience that again. The good news is that it went on up from there and put in a new high. Actually, it's 98. So you know what the market did up till 2000. In this case, you're seeing a rally of 20% straight up with no meaningful correction. And that is rarer still. So really, when we come back to portfolio management, we know that markets are going to fluctuate. They're going to fluctuate because supply and demand shift over times, and it goes from highly emotional to complacent environments. And our job with adaptive portfolio strategy is to adapt to whatever environment we have and to stabilize it and try to hold these declines to normal corrections. And in this particular case, I think we dropped below our 12% threshold for 3 days.
Three or four
I think
days,
it's about
yeah.
3 or 4 days. So again, one of these times in the future, we're not going to get a rally back like this. What we're going to see is a period of high and increasing volatility, and then we're going to see a 20-30% decline that's going to last for a period, and that's going to be very difficult for investors, and it also destroys the impact of what everyone's goal is, which is
compounded returns.
Getting compounded returns. Volatility kills compounding. So again, there is a look at what we've just gone through, which is very rare, but I think it can be a great learning experience for all investors.
So with that, we'd like to thank you for listening to this video. Please take a moment to read the following disclaimer, and we look forward to talking with you soon. Thanks.